Well, the S&P 500 rallied for the third straight day here today. A lot of the postures from an intermediate term perspective are turning back to bullish. A lot of the sectors that led us higher today were the expected more cyclical areas, kind of the risk-on sectors that you would assume, except for one holdout, and that's the one I want to focus on for today's trade application example. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's April 5th, 2018. If you're new to David and I's videos, we want to welcome you in. First of all, make sure that you are clicking subscribe on the YouTube video there. That'll let you easily get access to the videos as we produce them on a daily basis. In addition to that, we'd encourage you to also click the thumbs up icon on YouTube if you enjoy these videos and you want to see us continue to do them on a daily basis. You're welcome to leave us comments down below, and also make sure you check out our description area where there are some helpful links, including a link to sign up for our email distribution list, which will entitle you to seeing which stocks in the S&P 500 are giving you overbought and oversold cluster signals for that particular day. In addition to YouTube, we're also heavy users of Twitter. We'd encourage you to follow us on Twitter. My handle is @BrandonVanZee, all one word. The Market Scholars handle is @market_scholars. And I think we're only about 3 people away from having 1,000 followers on that corporate handle of ours that we recently established. So will you be the 1,000th follower for us or not? Hopefully many of you are already doing so, and we thank you for that. But keep in mind that we also post our market outlook tweets and pin them to the top of our timeline to make it nice and easy for you guys to click like and retweet. We also allow for a way to do that through our website at Market Scholars if you so desire. In addition to Twitter, we're also on Facebook. You can see the user group web address in front of you on the screen. Feel free to join that group. We've got about 1,000 strong there as well. All right, with that, let's go ahead and do some analysis on the markets. And you can see here that I've got the S&P 500 pulled up. As mentioned before, we were up for the third straight day. So you can see that third candle off to the right here, and giving us a little bit of a spinning top feel to it. But it was an above average day, 0.7%. Now, one thing I wanted to highlight here in the presentation today that I normally do not is I've got a kind of a different technical indicator pulled up down below here. And it's a way for us to kind of get a sense of volatility through a different lens. It's a way for us to look at how volatile or not the markets have been from a one-day basis, a one-day percentage move basis. So let me kind of explain what we're looking at down below. You'll see that there's some green bars up at the top, there's some red bars at the bottom, and they kind of represent the percentage move. If the stock market was up that day, like it was today, you'll see that bar is green and it's above that zero line. If the stock market was down, like it was 4 days ago, then you've got that red bar down below, and that red bar's size is determined by how big how much the stock market had sold off in that particular case. The size of the green bar is going to be determined by how much the stock market went up that particular day. I've also added 2 blue horizontal lines to this indicator to signify where the 1% level would be. And the first point I want to make is that we've had a lot of 1% move days here recently. Some of you have felt that. No doubt there's a lot of roller coaster type of action that we've had in the stock market recently. A lot of things going on with trade tariffs and different things like that going on in the media from a political perspective. Of course, we got some big jobs news tomorrow, so who knows, maybe we've got another one on the horizon. Today was actually the first day in a week where we didn't have a 1% move. So although a 0.7% move would have been considered above average in the year 2017, it's actually in the last week considered an undersized move. You'll notice that this bar, this bar, this bar, and this bar all touched those blue lines, meaning that on the 3 bars to the upside, that was more than a 1% up day for the S&P 500. On this bar over here, it was more than a 1% down day on the S&P 500. Of course, that's a trend that we've seen since the chaos that ensued way back here in late January in this case. You'll notice that we have a lot more of these bars here. So you might look at what we've had here recently as kind of par for the course, but it's easy to forget what kind of market we just came out of. And so let me do this. I'm going to come over here to the 1-year daily chart. and kind of want to prove a point to you here through a different visual. So what I'm going to do, just to make it a little bit easier for you to see, is I'm going to pull that one indicator up so that way it's a little bit easier. I know some of you watch this on your cell phone, so those screen sizes can be kind of small. But you can kind of see here that as we look back over 1 year, that the chaotic activity that we've been involved with here for the last 2 months or so is not what we were used to prior to that. Notice that nearly all of these bars going from, let's call it September 12th, all the way through the end of January, we basically, during that entire time period, only had one candle that was up 1%. Right there. That candle looks like it touched that blue line there. We had no candles touching the bottom blue line, telling us that we didn't have any 1% down days during that entire stretch of time. And even prior to that, you can see that we had very few of those days in comparison to what we had over here. This looks like kind of a Richter scale, and just actually heard something on CNBC that you guys might have experienced one out in the Los Angeles area, so hopefully everybody's okay. But anyway, you can see the choppiness that we've had here from a percentage basis. That seasick action, that up and down and up and down, is enough to be a little bit nauseating if your first experience in the stock market is what we experienced back in this area in 2017. So anyway, I just wanted to highlight that. Sometimes it's helpful to see a slightly different visual to get a feel for what we're actually experiencing in the market. This is certainly a different type of a year that we're experiencing in 2018. So as I go back over here to my 3-month daily chart, just to finish up on the S&P 500 here, again, third straight up day, we now have a green background colored chart. That's a positive sign. Remember, that is a sign that we now have a bullish intermediate term posture. You can see down below here that green intermediate line on the market forecast technical indicator has now emerged out of that lower reversal zone and is now heading higher. And so we'll see where it takes us. Right now, I'm a little bit cautious still, despite the bullish posture. Part of the reason is because so far in 2018, it feels to me like it's an environment where we sell the rips and we buy the dips type of an environment. 2017 was the opposite. There was a trending market, higher highs and higher lows, where using a posture development tool like the market forecast can be more beneficial. When we're in a choppier market like this, you might be getting a signal that your posture is X, but the best next trade for you could be Y, simply because that's not the type of market that we're in. Remember, a lot of the folks that use that green line are trend traders. Trend traders would not be very happy with the type of market action we've seen so far in 2018. Swing traders would probably be a little bit happier with this style of action. So as we stand right here, notice that that moving average line continues to be red at the current spot, signifying that price is still below a falling moving average. So right now we're kind of stuck somewhere in the middle of that range. We're not at the bottom. Thankfully, we bounced off of there, but then again, we're nowhere near our all-time highs that we hit earlier this year either. So this is kind of no man's land at this point, where we have to be a little bit more selective with our trades. As we move on to our next chart setup, let's take a look at this foregrid here that will show us all 4 major indices here in the United States. And you'll notice that all 4 of them have the green background color, telling us that according to the market forecast intermediate term line, they have bullish postures. But in all of the cases, except for the Russell 2000, we have red tails to those moving averages. In the Russell 2000, we have a yellow tail, which signifies in this particular case, price is below a rising moving average. So those two things kind of disagree with one another there. But in none of the cases do we have a green moving average. So we're still in a wait and see mode. We don't know if we're going to get there or not. The Russell 2000 did reasonably well today, up 0.7%. But one thing I do want to highlight, and this will kind of be driving what we'll be driving towards in my trade application example a little bit later as well. Notice down below on the NASDAQ. NASDAQ was only up 0.49% today. That was well below the averages of the other indexes that we're covering right here. Not only that, but you can kind of see that candlestick formation right there is potentially going to be a hanging man candle. Now remember, we need a confirmation day the next day, so we can't go on record stating that yet, but that's kind of how it's shaping up right now. Not necessarily the best looking picture there either. So we're going to keep our eye on that, but notice that the NASDAQ all of a sudden seems to have become the whipping boy of the market, and it is now the furthest away from the moving average. So with all this talk about trade wars and tariffs and everything, you would assume that it's the Dow Jones Industrial Average that's really struggling in that environment, because that's where you've got your most multinational companies. But you'll notice that the Dow Jones has rallied all the way back, is now touching that 30-day moving average. The S&P 500 is not that far away. And in the Russell 2000's case, we're touching the moving average there as well. Notice the gap between price action of the NASDAQ and where the moving average of the NASDAQ is right there. So maybe a little bit of underperformance from a relative basis there in some of that NASDAQ area, which is oftentimes driven by high tech. In particular, of course, we've had a lot of news items out of companies like Facebook that have caused maybe a little bit of concern for tech-oriented investors. Let's go ahead and take a look at our next chart now. This is also going to be a 4-grid, but in this particular case, we're looking at a 3 green arrows method of evaluating technical strength. And what we're referring to when we say something like 3 green arrows is we're just looking at 3 different technical indicators. The first one would be the 30-day moving average in this particular case. The second one would be the MACD, and then the third one would be the stochastics. Well, you'll notice here that there's one chart that stands out. Again, that's the NASDAQ. So kind of put a pin in that and think about that for a second. Remember, all the other ones are strong enough to at least have mixed signals of green and red arrows. The NASDAQ is kind of the laggard of the group. It's the one that remains with the 3 red arrow signal, where we've got the red arrow there under as the price went below the moving average. Still have the red arrow in existence from the MACD perspective, and you still barely got a red arrow there on the stochastics. But you can see that the MACD and the stochastics are right on the brink of potentially eliminating those red arrows if we get a couple more updates. Time will tell. What we do know is that in this particular shorter term move that we're experiencing here recently, the NASDAQ appears to be the laggard of the group. Moving on now to our longer term chart. This is our 1040 crossover method chart here. Now this is a 3-year chart that we're looking at in all 4 of these cases right here, and every one of these candles represents 1 week in time. And when we were looking at the charts a couple days ago, they looked worse than they did today, and I reminded you that, hey, early in the week when we look at these charts, don't read too much into it. Reason for that is each one of those candles is 1 week in time, and we can't really verify it or confirm it, I should say, until Friday has come and gone. And so as it stands right now, the candles are looking better right now than they were just a couple of days ago. You'll notice in most of the cases, the candles are trading near the high end of the weekly range. Now again, tomorrow could be a big day with the jobs number and all that coming out, so that could all be unwound in a heartbeat. We don't want to assume anything at this point, but I will say that the charts are firming up a little bit here. Again, this has been our 3rd straight up day for the S&P 500, and so that's kind of helping bail out this particular chart a little bit. Now you'll notice that the orange lines are still pointing down. Those orange lines represent the 10-period exponential moving average. The black line represents the 40-period exponential moving average. What we're looking for are crossovers of those lines themselves, and when those crossovers do occur on my charts, it'll actually go from green to red in that particular case. So be on the lookout for that. We'll, of course, alert you to that at that time. But the idea behind these charts is longer term money, maybe mutual fund money, maybe 401k type of money that you can't trade in and out of very actively, but you just kind of want to be on the right side of the market. This would be one approach to consider for that. All right, let's go ahead and take a look now at our 12 grids. And we'll start with the sector 12 grids in this case. Of course, got to kill that camera feed so that way you guys can see all areas of my chart. And you can see here that it is a different picture than when I was doing the evaluation just 2 days ago. In this case, we got a clean sweep. All of a sudden, all postures from an intermediate term perspective are now bullish. And that's why we have green charts in all 12 of these charts here in front of us. But like always, there should be ways to kind of compare and contrast charts to one another. There's more than meets the eye. And what I would say is there are 3 particular charts that are looking a little bit more robust. That includes the energy space up here, which we've been kind of talking about. I mentioned on Tuesday when we took our trade then that energy was the strongest performer of the day that day. It was right up there with the strongest performers here today. It was basically tied in this particular case with its neighbor just to the right there, materials. They were both up about 1.8%. But you'll notice the difference in those charts. Energy has been kind of stabilizing here since the end of January. That may sound familiar because, of course, that was the time when the markets really started getting chaotic from a broad perspective. So kind of interesting that this area that you would tend to think is more cyclical actually was a stabilizing factor in the market during all the chaos that we just have gone through. Not only that, you'll notice that today's candle was a nice move higher, well above that moving average, which just flipped to a green tip on that moving average. In fact, let me right-click on this and go to Maximize Sell so you can see that in a little bit greater detail. There's that green moving average right there, which signifies price is now above a rising moving average. We haven't had that except for briefly we had it right there, but that was a one-day move and then we quickly reversed it back. But really, since we consistently had that green moving average, was way back here more than 3 months ago. So we'll see if this leads to some maybe renewed energy to the upside for the energy space. Didn't mean to have that pun in there, but that'll work for me. Anyway, this one is starting to look a little bit more robust. So as we come back over here, let's take a look at a couple more. Notice utilities and real estate. We talked about both of those on Tuesday as well. They continue to be resilient. Notice that both of their moving averages are also green. Now in these two cases, these are both defensive areas of the market, so we shouldn't necessarily be cheerleading on these two groups to be rallying if we want a really robust bull market going forward. Energy, yeah, we could make that claim, but typically you don't want your leaders to be real estate and utilities, but that is what the market is giving us right now, so it's worth sitting up and paying attention to. One chart that I wanted to highlight that is not doing what I would have assumed is right over here. Information technology. It's a chart in the middle off to the left. Let me also pull up the Market Watch tab here. And I want to show you that as I stack rank our winners to losers here today, notice that up at the top we've got things like materials and energy and consumer discretionary and industrials. That's what you want to see on a risk-on type of a day. But one area that is, suspiciously missing from that group is technology. Technology, especially in recent years, has been kind of the workhorse of the market. And it's where a lot of growth-oriented investors try to plant their seeds. Well, take a look at where technology ended up here today. It ended up right down here with consumer staples, real estate, healthcare, and slightly less than utilities, meaning that technology was bunched up with all the defensive areas on a day where the markets did quite well, and you would have assumed that technology would have been one of the leading areas, and it wasn't. So it was only up 0.41% today. Again, that candle today looks a little bit like the NASDAQ one that I referenced before, potentially setting up with a hanging man type of a candlestick pattern. And of course, you remain with this big gap between the moving average and where the price action itself is right now. Whereas a lot of the other sectors out there are a little bit closer to that moving average, again, signifying that there may be some sector rotation that is taking place underneath the currents of these markets. And where we once had technology be a leadership group for eons, we may now start to see them passing the baton on. That can change in a heartbeat. There's a lot going on in the world, and news can change the way that investors will view these various sectors. But right now, that is one thing to take note of. And so we will focus on that area here in just a bit in our trade application example. Before we do, let's go ahead and take a look at our next 12 grid, which will be the foreign markets 12 grid. Now here we do not have a clean sweep. We do have kind of three holdouts from a bearish perspective. Australia, we've also got Israel and South Africa that remain bearish at this current time. But the other markets, very similar to the United States, in the last 48 hours or so have become robust enough or firmed up enough to be giving us bullish postures again. Again, that doesn't guarantee anything about the future, but it just kind of helps you determine, where's your next trade going to come from, so to speak. In these particular charts that remain, if we were to kind of break them down the same way we did with the sectors a moment ago and look for those that have the green-tailed moving averages, let me just check over here on China. Nope, China does not. Mexico does. So that's one that I have been pointing out in these videos here recently. That's been one of the leading areas from a foreign perspective here recently. So it now has that green tip of that moving average. Might be worth looking into. Also notice that it broke above kind of a double topping area right over here from mid-February and then once again here in mid-March. Now today's candlestick didn't look all that impressive, so you got to be a little bit leery of that. But to tack on any gains to what it received yesterday with this monstrous candle right here is impressive. It probably could have had an excuse to give some of those gains back from yesterday, but it decided it would tack on another 0.13%, I should say. So that one has a green tail. We also have a green tail out of Japan, but I don't think this chart looks quite as strong as Mexico, so not sure if I would be nearly as excited about this one. Notice that its price action is not breaking out above any prior resistance areas. So is that a starting point to get that green tail on there? Yes, but we don't want to overdo our enthusiasm with that one either. And then finally, this one is hidden a little bit. Let me see if I can kind of show you this. If I right-click, go to maximize sell. There we go. Sometimes depending on the size of your screen, these little labels that are on the chart can block some of the other scripting that's going on. So anyway, now you can clearly see that this moving average on the United Kingdom is now green. And this one I would kind of liken a little bit more to Mexico. I think Mexico probably still looks stronger, but this one at least looks better than Japan. Notice that this one we did break out fairly nicely here and actually closed near the highs of the day on the United Kingdom, where we were able to break out above this resistance area back here in mid-March. Now we have another one to contend with from mid-February that'll be coming up, so we'll see if we can break through those areas as well. But that intermediate term line is trending up nicely. In fact, that's the highest level on that intermediate term line since going all the way back to basically right here in the first week of February, where all the world markets started melting down. So some nice stability there out of the United Kingdom. Keep your eye on that one. Let's now take a look at our final 12 grid, which will be the intermarket analysis 12 grid. Here we do have a much bigger mixed bag, and again, that's by design because these are not always stock-oriented charts that we're looking at here. They can be anything from commodities to interest rates, to volatility, and you name it. Anything goes on this particular grid setup here. So we will have some that will do kind of the opposite of stocks in many cases. And so if stocks are doing really well right now, then there's going to be many of these charts that will have more of a tendency to do poorly. So as we stand right now, the charts that maybe have some interest to me, I like to keep my eye on TNX. As many of you know, I'm a pretty serious income-oriented investor, mostly on the dividend stock side of the equation, but it's important for me to keep my eye on what's happening with the interest rate environment of the U.S. Treasury bonds nonetheless. And I mentioned a couple of days ago when I was doing this video that we've had a fairly nice pullback in interest rates here recently, but I was getting a little bit nervous that all of a sudden we had 2 straight bullish cluster days there. If you want to see what that bullish cluster will look like, I'm going to right-click, go to Maximize Sell, and that's when we have those market forecast lines all in the lower reversal zone on the same day. So you have the green, the blue, and the red all in the lower reversal zone on 2 straight days right there, and that's why those 2 dots are being plotted there and also up here on the corresponding candles. And so, as I mentioned before, the fear there is that we get a reversion to the mean when we see something like that, and that is what we have seen. We've seen 3 straight days to the upside on interest rates, and with the stock market going up for 3 straight days, it's not a surprise to me in this particular environment that we're in that the yields themselves have gone up for 3 straight days and bonds have gone down for 3 straight days. The question is now, what's going to give? You know, is this going to slice through this downtrending 30-day moving average right here, or will this 30-day moving average be used as a resistance area? A lot of times when we have transitionary markets, they'll use those 30-day moving averages as launch pads either up or down. Notice that we had this big move higher in interest rates over here. The first time we came down and we touched that moving average, we used it as a launch pad back up. Eventually, that ended up slicing through the moving average, but now the fear is, now that we're down below these areas, now when this does go back up, revert to the mean and touch that moving average, is that now going to act as resistance? Is it going to now start bouncing down? Of course, a lot of that will depend on what the sentiment of the market is at that time. If we all of a sudden go into bull mode again in the stock market, my guess would be interest rate expectations will go up, and all of a sudden you'll see TNX go up as well. On the other hand, if we keep on hearing more about this saber rattling regarding some of the trade war rhetoric that we've been hearing here recently, then my guess would be markets become fearful. They decide they want to hunker down in more risk-off types of securities, including U.S. Treasuries. If U.S. Treasury prices are going up, then these yields will likely go down. So it really depends on what shakes out from a news perspective and just what your expectations are as an individual practitioner within the markets themselves. All right, so that then leads us to our trade application example for the day. Let me go back over here to just a regular market forecast chart, and the stock that I wanted to focus on today was F5 Networks. So you guys kind of heard the theme of the video tonight was it's good to see the markets back in rally mode. You know, most of us are much more long the market than short. I certainly include myself in that camp. Remember, most people have, you know, long-term money in 401ks or what have you. So usually if somebody is bearish on the markets, it's in a more speculative, smaller account. So generally speaking, I want to be you know, happy whenever the markets do rise like they have over the last 3 days. But at the same time, I want to kind of look at the markets with clear eyes and recognize that 2018 has been a market where you sell the rips and you buy the dips. And we just started ripping here in the last couple of days, the last 3 days. And so my fear is that that big part of the move that we might be deserved of has already been taking place, and now we might see the bears come back in again. Now, whether the reason behind that is we've got a poor jobs number tomorrow, or again the saber rattling, or who knows what else could come out of the woodwork, but the point is, it seems like 2018 has been a year where traders have looked for excuses to sell rallies. And so if you're kind of operating with that mindset, a lot of times you're looking for tells within the marketplace. And again, technology today seemed out of what you would have expected with technology. Typically, when we have a big up day in the market, you expect technology to be a leadership group. Well, you'll recall that a few days back, can't remember when it was, we did the bear call spread on Avgo, Broadcom. And you'll notice Broadcom was down today. Again, remember, the market was up substantially today, 0.7%. To have a leadership name like Avgo actually finish in the red is not a very strong sign. We already talked about some of the bearish elements of the NASDAQ. We also talked about some of the bearish elements of XLK. And so if we look at F5, it's kind of similar to Avgo, where, you know, you would have assumed that a kind of robust, high beta type of a name like this would have been up on a day like today. It was down 17 cents, closing near the lows of the day right here. Of course, continuing to have this bearish posture, which is why that background color of the chart is pink. We also see that the moving average itself is red, signifying that price is below a falling moving average. Be aware that this company does have an earnings report coming up, but as I went over here to the trade tab, I think I was able to find that we could actually do an April contract where we could get out before the earnings are announced for this company, for those of you that like that sort of thing. Now, you know, one of the things I was working with someone else on here earlier this week was this idea that if you need to go through an earnings announcement with any type of a strategy out there, you know, a sold credit spread is not the end of the world. Reason for that is you've got a built-in hedge. That's the exact reason why you have a bought strike combined with your sold strike in there. So, you know, some of you like to trade through earnings. Some of you do not. Some of you kind of get excited about, you know, some of the movements that you have. Everybody kind of falls on a different side of the coin on that particular argument. But be aware, the nice aspect of selling credit spreads is that you can define your risk. And so that's an important thing going into something like an earnings announcement. But I certainly respect the fact that some of you do not like to trade through earnings announcements, whether you have defined risk or not. And that is the good news with this trade, because as I come over here, I'm going to look for a delta of 30 on our April monthly contracts that only have 15 days until expiration. So this delta of 30 spot on is going to lead us to the 147 call for F5 networks. As I right click on that and go to sell vertical, I then am loading up a $1 wide, which the system loads up by default. And you can see that I'm going to get a 26-cent credit out of that. Now, typically what I'm looking for on a $1 wide is a 24-cent credit or above, because that's where you get your 30% return on risk. So if it's going to give me 2 extra pennies here, it usually leads me down the path that if I'm trading a $100 security or more, I might be better off actually expanding the width of my strikes in my spread to 2 rather than 1, and that way I can save on commissions a little bit more, because typically, let's say you ended up doing 14 $1 wide contracts. If you do a $2 wide contract, you could probably do 7 instead and still have the same benefit of that trade. And a lot of times brokers will charge you less if you're doing less contracts. Not all, but some will. So I am going to attempt to go out to the 149. And in this case, that leads us to a 47-cent credit, which is basically scraping the bare bones minimum of what I'm typically looking for with a 30% return on risk. For those of you that aren't familiar with that concept of return on risk, let me explain here. The easiest thing for you to do to calculate it, by the way, is just click on confirm and send once. Then that order dialog box comes up. Then get your calculator out and take the max profit, in this case $47, divide it by the max loss, 153, getting that number right over here, and then just hitting equal sign, and you can see that that's a 30.7% return on risk. It is a higher probability trade because remember, what we're really saying, for those of you that are a little bit newer to options trading, is this security that's $143 right now can do a variety of things in the next 15 days. It can go down, which we want, and we will win. It can go sideways, which is a little bit less ideal, but we won't mind that because we'll still win. It could go up a couple of bucks. We could still win. What we don't want for it to happen is to go up dramatically, because if it goes up more than $4, then it starts breaching our short strike at that point, and then our trade does have a stronger potential of losing money. So it is a higher probability trade because it allows for a lot more possibilities to occur price-wise, and you still end up making a profit on the trade. But it doesn't eliminate all risk, of course. Very few trades ever do that. And so we understand there is some risk in taking this trade. But for those of you that are maybe a little bit more bearish on technology or the NASDAQ or F5 specifically, maybe it could be a way to practice some of those bearish trades for those of you that are just kind of getting started here in this environment. So I'm going to go ahead and let's just do kind of a generic 5 contracts here for this $2 wide spread. Confirm and send, and we'll see if we can get filled on that tomorrow morning. All right, appreciate you guys checking out the video here tonight as always. Another interesting day in the market, third straight up day. Mostly a risk on environment that we are in today with the lone exception of technology, so we're going to keep our eye on what's going on there. Of course, we also found out that Mexico is an interesting place of market strength, and so it might be worthy of you keeping your eye on Mexico as well. And of course, finding out a little bit about the interest rate environment. We've got the jobs number tomorrow. That can affect a lot of things from a macro perspective, so keep your eye on the story. David will be back with you tomorrow. I'll be back with you next Tuesday. I look forward to that. In the meantime, I want to wish you all the best with your trades and your investments. Goodbye for now.